don't have to revalue gold at a new floor of 10,000 or even 20,000. It'll get there on its own, and then you can revalue your certificates then. I think they're just going to wait until gold's at a higher valuation. There's actually, ironically, a vested interest for the U.S. Treasury Department to see gold run, to let gold run, because when it's at a higher valuation, that's when they're going to decide to hit the button and revalue their certificates. They're based at $42 right now. So those 260 million ounces will have a lot more value revalued at 10,000 or 20,000 or higher than they will at 4,000, 5,000, or 6,000. And I think they know that gold can go that high.
The quiet rise of gold is exposing a seismic truth in global finance. Confidence in fiat money is collapsing, and the system built on unlimited credit is reaching its endgame. The U.S. Treasury, long seen as the cornerstone of global trust, now faces a dilemma of its own making. With debt spiraling past $38 trillion and inflation understated, America's IOUs are being revealed for what they are: constructive defaults masked by creative accounting. As this reality unfolds, the logic of gold revaluation becomes impossible to ignore. The Treasury holds 260 million ounces of gold valued at just $42 per ounce on its books, a relic of the 1970s. At $10,000 or $20,000 per ounce, those same holdings could quietly reset the balance sheet and buy time in a crisis. MatthewPiepenburg, partner at Matterhorn Asset Management, explains that the U.S. may eventually let gold run before officially revaluing it, using market price discovery to inflate its reserves. This isn't speculation. It's a structural necessity born from debt saturation and a loss of global faith in paper promises. As he argues, the era of "our currency, your problem" is ending. Gold's next chapter is the world's monetary reckoning. Now, we present the clips from MatthewPiepenburg's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I mean, if you listen to Judy Shelton, it's not a rumor, it's going to happen. Of course, Elon Musk a few months ago also said the Doge is going to cut $2 trillion out of the spending within the next year or 2 years, and none of those things have happened yet. I think she's very serious about it. Can I predict with certainty that it'll happen? I can't. She's saying it will. I think the very fact that we're even talking about that someone like Judy Shelton is convinced it's going to happen, is in and of itself telling. And we've tried to do a gold-backed treasury in the past because after we got off the gold standard, after the Civil War, there was a bunch of cases that went to the Supreme Court, and I won't get into the weeds of that, but basically the Supreme Court was saying, well, we don't need a gold-backed treasury because, our dollar is just as valuable as gold or silver. Of course, that wasn't true. That was the politicization of the legal system with bad math. But what Judy Shelton is saying today in 2025 for what's going to happen in the future is, that's a confession that for our Treasury to be more trusted, for our IOU to be more trusted in the world, it can't be backed by something like a dollar. It has to be backed by gold. That is a confession that gold has greater confidence and greater faith than the greenback. And that's not a radical thought anymore, because the world is seen. Again, to your earlier point, if you have a peso in South America and Argentina, you'd much rather have a dollar. You'd much rather have a Swiss franc than a dollar right now, though. So it's all relative to what jurisdiction you're talking to. But in absolute terms, all major fiat money is losing value to gold. So for Judy Shelton to do that, to even say that as a confession, in terms of a revaluation, that too is making the headlines recently for obvious reasons. These are things that would have been unheard of 10 years ago. This would have been unheard of pre-COVID in the fiscal spending and the debt levels. Now we're at 38 trillion. I mean, the public debt just keeps getting crazier and crazier. These headlines wouldn't even be taken seriously. Now we're talking about gold revaluation. To your point, the Fed can revalue its gold certificates to market today, or it could, to your point, have the Treasury and the Fed offer a bid to market at a higher price than spot and make a new floor in gold. I think there's a number of reasons why that's inevitable. I know that the head of the Bank of America said it's inevitable. The question is, inevitable doesn't mean we can time it. If I were at the Treasury Department right now and gold's at 4,000, I could revalue gold today, our certificates of gold today, and buy a little bit of time, get $1 trillion plus in gold, and basically QE gold, use that revaluation to get some money to buy some U.S. Treasuries, take $1 trillion off the table. But why not wait till gold's at 8,000 or 10,000? You don't have to revalue gold at a new floor of 10,000 or even 20,000. It'll get there on its own, and then you can revalue your certificates then. I think they're just going to wait until gold's at a higher valuation. There's actually, ironically, a vested interest for the U.S. Treasury Department to see gold run, to let gold run, because when it's at a higher valuation, that's when they're going to decide to hit the button and revalue their certificates. They're based at $42 right now. So those 260 million ounces will have a lot more value revalued at 10,000 or 20,000 or higher than they will at 4,000, 5,000 or 6,000. And I think they know that gold can go that high. Many say that's pie in the sky thinking. When we saw Bitcoin go from 10,000 to over 100,000, that wasn't shocking because no one took it seriously. If gold went from 10,000 to 100,000, that would be scary because the world's stacking gold, the central banks are stacking gold, and he who has the most gold wins. It's a longer conversation, but I think they're going to wait until gold's at a higher valuation before they revalue gold, because it's one and done. You don't want to do it at 4,000 or 5,000 if it's going to be 10 or 15,000. And eventually in our lifetimes, Elijah, I'm quite confident it will be. Not because gold gets shinier or because gold gets more headlines because there's more jewelry or wedding rings or dental fillings. It's because fiat money across the spectrum is just losing value versus gold because it can't be created ad nauseum like paper money can, and it holds its value better. And the fact that, unreported or misreported or malreported inflation is much, much higher than 10% or the 3% that we're saying it is now, that means that anything you're getting on a U.S. IOU from the short end of the curve, from a T-bill all the way to a 30-year U.S. Treasury, the yields you're getting on all those IOUs from Uncle Sam are completely negative returning because inflation is much higher than the actual yields on those bonds. That means you're getting a negative returning bond. As I've said many times, a negative returning bond from Uncle Sam is a defaulting bond, constructively a defaulting bond. So we're already constructively in default. The way we get around that is we just lie about the inflation rate. It's not even close to accurate, but it is the official rate. So that's the number we can measure our risk with, but it's absolutely fictional. So if you and I see that, if many of our listeners already see that, of course, China, Russia, the BRICS, the other nations of the world see that, and that's why they're turning their back on the U.S. dollar slowly, not overnight, but slowly but surely. And certainly since we weaponized the dollar in 2022, as I said then, the jig is up now for that. That was a watershed moment, as big a moment as 1971, because the world will no longer trust a weaponized neutral reserve asset. And that's why de-dollarization has gone so exponential. That's why the oil trade has gone off the petrodollar so fast, not completely, but it is significant trend, and that's why central banks now hold more gold than U.S. Treasuries. Again, something unthinkable 5 or 10 years ago. It's all happening right now. History is actually happening right in front of us. When you have a world reserve currency, this is Robert Triffin, this is Triffin's dilemma. He warned of this in the 1960s. If you have a world reserve currency, there is going to be greater global demand for it, and that means your currency will always be relatively, for the most part, stronger than most other currencies. If your currency is stronger than most other currencies, you're going to be running trade deficits. It's going to be harder to export your widgets, your toasters, your blue jeans, your car parts, your tires, your whatever, to the rest of the world when it's more expensive because the dollar is more expensive. So that creates a natural trade deficit. It's no fault of the manufacturers themselves, but what Triffin also says, eventually the CEOs of these companies, the producers of these widgets in the US are going to see that we have this problem. Our dollar is too strong. Our cost of labor is too strong. We're going to offshore that labor to cheaper zip codes where labor is cheaper and our margins are better. And of course, we've certainly seen that since the World Trade Organization in 2001 when we outshored the American dream and made it in China, because the American dream was made in China for decades. And so that was what Triffin warned. That's the paradox. You have a stronger currency, you're going to have a trade deficit, manufacture is going to be hollowed out in your own country, it's going to be pushed overseas. And look, myself, Luke Roman, and others who are from the Midwest, we see the Rust Belt. We see what Triffin's dilemma, how it played out since 2001 when Clinton signed the World Trade Organization, let China into that. It just meant a major segment of U.S. manufacturing and U.S. production went offshore. And so that is another dilemma of being the world reserve currency. It's a paradox. And so to your question, would a cheaper dollar actually help us? Would we be unburdened by that exorbitant privilege if we were off the world reserve currency status? In many ways, yes. And Trump wants a cheaper dollar, a weaker dollar for his trade deficits, but he's fighting against these larger forces. as Jeffrey Sachs said, you can't blame the mall if your wife takes your credit card and she spends too much on it at the mall. It's not the fault of the mall, it's the fault of your spending. So you can't blame the rest of the world that our dollar has been too strong and that our work has been offshored. The problem is our own problem with our currency and, of course, with our spending. And so, again, another long answer to a short question. Just debasing the dollar, though, as we try to do, won't be enough to compete with labor costs in the BRICS and certainly in China, at least for now. But I think this our currency, your problem paradox is now coming to an end. It's now our currency, our problem. And the dollar is being debased at a massive absolute pace versus gold, at a relative basis versus other currencies less so, but still occurring. But until we lose that world reserve currency status, and it's not going to be anytime soon because it's not going to be replaced. The world reserve currency is not going to be replaced by the ruble, the rupee, the yuan, or the Swiss franc, or any of those currencies. Instead of seeing a new world reserve currency, what we're going into is a multipolar era where regional currencies will use for trade and they'll be net settled in gold. And that's really what the BRICS have been playing at the long game for, already preparing since 2014, accelerating since 2022. And we're going to see even more so in the next couple of years. Gold as a key financial tier 1 strategic reserve asset used for net settlement. And instead of going at the US dollar like the Maginot Line, the world's just going to go around the US dollar, which they're already doing at a quantifiable pace. So even if the world reserve currency stays at the US dollar, the world's slowly and surely trading around it and net settling in gold. And that's why central banks have been stacking gold at record levels since 2022, over 1,000 tons every year. It's unbelievable. It started in 2014. It just accelerated when we weaponized that dollar in 2022.
Gold's true story isn't about the daily price action. It's about a profound monetary shift reshaping the global financial order. While traders obsess over every $100 swing, long-term holders recognize that these moves are insignificant against the backdrop of collapsing fiat credibility. The structural forces driving this trend are undeniable: record sovereign debt, persistent deficits, and an accelerating move away from the US dollar as nations and central banks seek real value in tangible reserves. History is simply repeating itself. Debt crises have always led to currency debasement, and gold has always been the asset that outlasts paper promises. The current era mirrors previous turning points in monetary history, from the Roman debasement of the denarius to Nixon's closure of the gold window in 1971. Each cycle ends the same way, with the return to sound money as confidence in fiat erodes. Today's revaluation isn't speculative, it's a mathematical inevitability. As central banks continue replacing U.S. treasuries with physical gold, the metal's role as a Tier 1 reserve asset is quietly redefining the next global order. Let's get back to the interview.
Gold is not a typical commodity trade. It's not a particular unique it's not a specific type of risk asset trade. It is part of a major status quo shift in the world and the monetary setting and the backdrop from which all these details spin. The larger question, the larger secular direction of gold is so obvious that these moves don't faze us because we hold gold for 10, 15, 20 years. Believe it or not, I'm not a big fan, as I said many times, of the BIS or the central banks or the East in general, but I'm doing what the central banks do. And all the investors at our offices are doing the same thing. We're holding in gold, or we're saving in gold, and we're spending in fiat because we see the longer term direction of gold well above 5, 6, 10,000 in the years ahead. So whether it's at 4,200, 4,100, or 3,800 right now, or the next week, or the next month, or the next hour, it doesn't faze us as gold investors, not as gold kind of traders, which we're not. We're not speculators in this space. So we've never really talked about the gold price. In fact, in the many years I've been with Egon, we never really talked about the daily price. Sometimes we won't even look at it. And that can sound very flippant. But even if you take if you take away the gold bias, the gold perspective that I certainly have and that Egon has, et cetera, I think of one of my favorite investors that I allocated to, Jeremy Grantham at GMO. He's been retired now for 15 years. He was a fantastic value trader and portfolio manager out of Boston. And he had many rules of investing, but one of the things he said is that, no one likes to think ahead. Investors have a very short time horizon when they look at things. And of course, the headlines are very short in the last week about the gold price. But if you step back at all the things you and I have talked about over the years, and you've talked with others, just keep it simple. right now, entitlements in the U.S. for the past 150 years is probably the biggest Ponzi scheme in history. We have 120% debt to GDP. We have $2 trillion deficits. We're seeing BRICS de-dollarization. We're seeing central banks stacking gold. We're seeing talk of a gold revaluation. We've got Judy Shelton talking about a gold U.S. Treasury. In other words, there's these massive indications of a seismic monetary shift, a geopolitical shift, and a currency shift going on in the backdrop of these intraday moves. These intraday moves are peanuts compared to the larger seismic shifts in the macro space, in the direction of the dollar, in the direction of debt, and of course the direction of precious metals. So why would you be thinking about, well, this market's topping out, I got to get out now at the top? Why would you want to sell a key asset with no counterparty risk when the entire world is riddled with signs of counterparty risk, from the U.S. Treasury and the U.S. dollar to risk assets to stable coins? To AI stocks. I mean, it's fascinating to me. But again, people think that maybe this is the end of the bull run. Again, I have my bias. This is chapter 1 of a very long novel, maybe chapter 2 for the direction of gold. And it's easy to get seduced by certain headlines. I mean, even during Weimar, when you started to see wheelbarrows of money, every now and then there'd be a headline saying, the Versailles Treaty has been amended, our reparations are going to go down. And people would actually start selling gold and buying more Reichsmark. Within the next 2 or 3 weeks, the currency was getting slashed by 200-300% or doubling every 2 weeks. They thought that the problems are over. The problems that gold is an anti-fiat solution to, the problems that gold is solving or basically doing nothing but hold its value while the rest of the world devalues, those are not going away just because there's a $150 move in the gold price during this particular day, up or down. These problems are so endemic to the global macro system and the global financial system. Again, long answer to a short question, Elijah, but no, these price moves don't faze me because I hold gold for decades, not for weeks or months. I don't trade them. I save in them. The 1,000+ clients that we have from 90 different countries are doing the same thing. And any gold investor right now understands this perfectly. It doesn't faze me in the slightest, Elijah. It's a short answer. In absolute terms, though, the dollar's losing purchasing power dramatically against gold and silver. And in absolute terms, all the major currencies of the world are losing value against gold. So again, it's a better store of value than paper money. And this isn't just a modern realization. This is the history of debt. I mean, again, from the 1700s, the 1500s, Sir Thomas Gresham always said that eventually bad money will, be replaced by good money, that people will save in the good money and spend in the bad money. This was in the 16th century, or certainly the 1750s. These cycles of really poor management of debt cycles. It goes back to ancient Rome with the denarius. It was all silver-based. And before the denarius, the ice currency was the Bronze Age of the Roman Empire. They would always keep devaluing their real money with something that had less and less hard assets behind it until no one wanted it anymore. And eventually it was replaced altogether. That was Adolf Thiers in the 1800s. So these are not things we're making up from 2022 to 2025 or from 2016 to 2025. These are cycles of credit, cycles of bad currencies, cycles of incredibly negligent mismanagement of spending versus income and debt versus income and deficits versus growth. We've gone over the numbers ad nauseum, you and I together, but it's very, very simple pillars here. You have too much debt. You debase the currency to pay for that debt. Eventually that currency becomes unloved. The IOUs from the government in that debt become unloved, and the world in general and the citizens in that country start to realize the purchasing power of their debased money is no longer as good as hard assets in general, and gold and silver in particular. This is a cycle we've seen throughout the centuries. It's very hard for many of us to accept that. No one wants to look at CPI scales or yield curves or other kind of dramatic Wall Street lingo or kind of wanky talk. But the bottom line is we all feel the inflation. We all feel it in our purchasing power. You don't have to be an expert in markets or in precious metals to realize you're being robbed and that the currency is being devalued right before your eyes. It's melting. And, this isn't the first time America's devalued its currency to get out of a debt crisis. We did it in 1933 when we went off the gold, when we confiscated gold and overnight revalued it from $20 to $35 an ounce. That was a massive revaluation, almost a 70% devaluation of the dollar. In 1971, when Nixon went off the gold standard, gold subsequently rose by 8,000% in the 50-year since, but immediately the dollar sank by 90%. So that was a deliberate devaluation plays of our currency to monetize a debt crisis. Again, twice almost in just the last 100 years. So what we're going through right now is the jig is kind of up, and the signs of that, again, I'm not making these things up. If you don't have to read all the history of Sir Thomas Gresham or even Reinhard and Rogoff modernings or the Austrian school. You can just look at the de-dollarization, where the DXY has been sitting, the deformed equity and credit markets, the U.S. Treasury demand, the selling of U.S. Treasuries net and the buying of gold net since 2014. As of this recording, central banks hold more gold than they hold U.S. Treasuries. And even Judy Shelton wants to issue a gold-backed U.S. Treasury at the long end. Why? These are just open and obvious signs that the world is turning away from a debased dollar, a debased greenback. Still very powerful, we can talk about that, but they're saving in precious metals because it holds its value better than paper money. We can't say it enough. There's 5,000 different ways to say it. We can't say it enough. This is not a gold bug case. This is a macroeconomic shift. This is a major shift. It's not the end of the world reserve currency, certainly not yet. It's not even the end of the dollar, but it is a massive shift from the petrodollar to the U.S. Treasury markets, to the gold stacking of central banks, to the BIS making it a tier 1 asset. What more evidence do you need that there is a shift here? So again, goes back to whatever the gold price does today or tomorrow is really irrelevant in the larger scheme of the direction it's going.
The global financial landscape is shifting in ways few fully grasp, and gold stands quietly at its center. What many see as volatility is merely the noise of a world realigning toward real value. The price of gold at $4,000, $4,200, or even $3,800 is trivial compared to the more profound truth. It's not a trade, it's insurance against systemic failure. Fiat currencies are melting, and trust is migrating toward hard assets. This isn't about speculation or trading, it's about preservation. For centuries, nations have cycled through monetary arrogance and eventual reckoning, and every time, gold endures. They are the final stages of another fiat experiment unraveling. Gold's rise is not explosive, it's inevitable. The longer the world denies this truth, the more powerful the eventual repricing will be. This is not a short-term trade, it's a generational shift. The next financial era will not be defined by who traded best, but by who understood value before the world remembered what real money is. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.